In the second video, we have referred to the disclosure of property, plant and equipment, but it warrants a little bit of closer attention again. Now, we have seen that under inventory, we had an accounting policy note. Now, the very same thing applies to property, plant and equipment. You have to tell the reader of the financial statement what depreciation policy this entity has adopted. Now, you've seen, if I'm going to work out depreciation, let's say on the straight line method, I'm going to get depreciation which is on an annual basis exactly the same as that of the previous year. Where I work with a diminishing balance method, you have seen that our depreciation charges in the beginning of the use of the asset is usually much higher than what it is later on when the asset becomes older. Production unit method, though, that was then calculated on the actual usage of the asset that we are talking about, and the more we've used the asset, the higher the depreciation charge was. So obviously, all things considered exactly the same. If I have two companies putting them next to each other and they have different accounting policies, they will have different depreciation charges, and therefore their profits before and after tax is going to be different, not really because there was a real difference in the way that they conduct business, but that there was a real difference in the way that they provide for depreciation. So, as the user of the financial statements, I would like to be able to do necessary adjustments so that I can compare apples and apples and pears if I put them all on the same footing. So therefore, it's important that we're going to have an accounting policy note on property, plant and equipment. Now, property, plant and equipment are stated at cost less accumulated depreciation. Other than freehold land and buildings on which depreciation is not provided, this is just an example. Now, guys, on average, on land usually never depreciates in value. Usually when I bought a piece of land, let's say 5 years ago, that piece of land, generally speaking, is now worth more than what it was 5 years ago. But buildings is a different matter. Buildings, if you do not attend to a building, if you don't maintain a building, you can clearly see that if you haven't done anything in a 5-year period of time, that building has deteriorated in the 5 years. So therefore, there's definitely depreciation that is applicable on buildings. Buildings by itself does not appreciate over time. It needs some maintenance work in order to keep the value intact. Good. So other than no depreciation, which is on land and buildings, depreciation is recorded by a charge to income computed as the right of the cost of the asset over the expected useful lifetime of the asset. And then we have to show them the rates and the method. So the rates on plant and equipment, 5 years on the straight line method. And then for motor vehicles, in this case, let's say 5 years on the straight line method. Now, if we, for instance, had plant and equipment on the production unit method, we would have said on the production unit method. If we had motor vehicles, for instance, on the diminishing balance method, we would have said 20% per annum on the diminishing balance method. I've already referred to the disclosure, the note, IAS 16 note in video 2. Just to recap quickly, I have 3 sections in my note. For each and every class of asset, there's a total for that class. And starting with the carrying amount at the beginning of the year, broken down in the cost and accumulated depreciation, the movements during the year for the additions, the disposals, and the depreciation, and the carrying amount at the end of the year, also broken down in cost and accumulated depreciation. Then we said that we also have to tell the reader exactly where this property is situated, and if any of these assets are pledged as security against a loan, the fact must be mentioned and there must be cross-reference to the type of loan that it serves as security for. Now, what is important, let's say for instance, we have vehicles. I'm a transport type of company and I have huge trucks. Now, for you guys who know something about a truck, So you have the trailer, which is the back part of the truck, and then you have the horse. Now the horse is really the thing with the engine in. Now guys, there is no ways that the estimated lifetime of the horse and the trailer can be exactly the same. The horse got the engine in, the horse got totally different kind of characteristics than the trailer, but the horse and the trailer makes up the total truck, being the vehicle. So, although I can write off the trailer, let's say, over 5 years, and the truck, for instance, let's say over 10 years, the horse part of the truck, the one with the engine, let's say over 10 years, I am going to work out a different kind of depreciation charges for the horses as well as the trailers, but because both of them belongs to the same class of non-current asset, i.e. a vehicle, I will add everything together and only show in my note one figure for the cost price, which will be the cost price of the horse and the trailer, one figure for the accumulated depreciation, which will be the two of them together, and that will then be also applicable to each and every one of those line items. So if I have something like a truck with a horse and a trailer, because both of the horse and the trailer is still equal to my class vehicles, I work out separately the calculations, but in my IAS 16 note, I will show that calculation together. That is quite important that you know that.